Banks were just hit with some awful news. Hey, everybody, you're watching Bull, Boom, Bear, Bust, back with another dose of economic reality. My name is JJ. We continue to document the demise of this economy and this ongoing economic collapse, with debt exploding higher like we've never seen before in the history of the United States. In fact, not just in the history of the United States, in the history of the world, we've never seen debt explode this fast and this much higher. Every time we look at the debt, it's accelerating. Not just that, consumer debt accelerating. Delinquencies are starting to rise. The stimulus money has been spent, and big banks are in big, big trouble. Let's go ahead and talk about what's happening at the banks here right now. Let's begin right here. FDIC thrown into turmoil amid push for biggest U.S. banking rules overhaul since 2008. Folks, we talked about this just recently. We've been bringing this up a lot more because there's new rules that are likely to be implemented. And some people say it's never going to happen because the system is too fragile. Banks are too heavily indebted with underwater assets to ever do this. And the economy is too leveraged on debt to ever do this. I get it. Some people say it'll never happen because it'll be the end of the economy, just like that, the snap of a finger. But here's what's going on here. FDIC thrown into turmoil. Why? Well, let's take a look here. And we're looking at a chart right here. This is deposits at large banks here. This is the United States. And we're seeing deposits continue to decline. Why? Because the consumer is tapped out and they're now pulling their savings out of the bank. They're taking money out of their 401ks. They're running up debt, like we said at the beginning, faster than we've ever seen before in the history of the world. And basically what this is a slow motion bank run. And we started seeing the acceleration of people pulling their funds out of these banks back in March when the series of bank failures occurred, but it is continuing. Now, the rate of deposits coming out of these banks has slowed down some, but it's still continuing. And that's disturbing, especially considering all the underwater assets of these banks. All right, so let's put a piece or a few pieces of the puzzle together. Let's connect a few dots here. We've got a double whammy, a triple whammy, maybe even a quadruple whammy. We've got money leaving the big banks. We've got defaults and late payments going higher. We've got underwater assets on the books of these banks. And when you look at commercial real estate, that's a nightmare. That's a disaster for these banks. And we have the possible re-implementation of capital requirements for the banks. Remember, we're still under an emergency that was issued in 2020 that said banks don't have to have any money in them to go ahead and loan out money, a zero reserve requirement. So if everything was fine, if the economy is strong and resilient, why are we still seeing zero requirement or zero capital requirements? Why is that happening? Interesting, right? And why are there several reports out now that there's going to be rate cuts next year? Let's take a look at a few of these reports now, see what's going on with that. The Hill, the Fed will cut interest rates deeply this spring, new estimate says. CNBC, UBS sees a raft of Fed rate cuts next year on the back of a U.S. recession. So do you see what's happening here? We're starting to see this floated out there by certain news outlets. And remember, they have to tell the truth every once in a while, because then when it does happen, they can look back and see, and they can say, look what we said. We warned you. Even though they rarely predict or they rarely forecast this type of economic environment. But it's interesting that we're starting to see, the obvious is being acknowledged here. We have no choice but a big economic downturn. The only other solution is inflate our way out of this mess, but that would cause the cost of living to go up even more. So we're in a trap right now, and it's not going to be easy to get out no matter what is done. Higher rates, lower rates. Lower rates actually will not rescue the U.S. consumer at this point, because the debt levels are just too high. Even lower interest rates at today's debt levels is still not going to be sustainable. They may pave a little more road to kick the can down, but it's definitely not going to fix the problem, right? What would fix the problem would be a collapse and a deflationary collapse. And then the cost of living would come down. A lot of the jobs that were created because of the economic money creation boom, the false boom that was not organic, it was actually um, inorganic. It was about as GMO as you could get when you talk about inorganic GMO. Um, it was based on a lot of debt and spending. And you look at the consumer, $17 trillion in debt, consumer being the backbone of the economy. So, what do you think about this? Are these publications correct with their predictions that emergency rate cuts are right around the corner, the spring? We're talking less than 6 months. Could they be correct? Well, when you look at everything that's happening right now and converging, I think they may be correct. And it could be war that's going to be the reason or the excuse as to why they have to do emergency rate cuts. I think we're going to see panic finally in the markets when this war expands, and what's going on over there, Israel, Hamas. I mean, it's a mess, but it's expanding. Right, we're seeing Syria involved, Iran-backed countries involved, the U.S. of course involved now, with casualties now and hostages involved in this whole situation, and it's just going to get worse. We warned about this, many months ago. This is going to get worse, and yes, I think this could be the excuse for rate cuts, and they'll blame the collapse of the economy, I think, on these expanding conflicts, especially when the U.S. gets more involved here. But let's go ahead and shift gears a little bit. A little bit of some lighter topics here. We talk about an economic collapse happening here. Let's go over here and see what's going on with one of the biggest companies in the world, Amazon. It will allow auto dealers to sell cars on its site, starting with Hyundai. Amazon next year will allow auto dealers to sell cars through its site, starting with Hyundai. And I'm going to guess Kia is going to be next. The company has slowly muscled its way into buying businesses over the years by launching a digital showroom for shoppers to research and compare vehicles. Now, this actually caused a bit of a sell off in some of these online car sales companies like Carvana. We saw, what do we see here? A sell off here from about $34 down to $32. Nothing huge, 6% though. And we see CarMax also a sell off after this news was announced from $68 to $64. Another 6% drop there. And I would be careful; these may continue to drop as Amazon. They're not big enough already. They have to come in now and try to take a chunk of the vehicle sales market. So pretty interesting how big companies never seem to get enough and always want to expand and venture into different territories. I also read that Amazon was offering some sort of health insurance. I'd have to look into that, but I did read something about that. In the meantime, the U.S. consumer is continuing to get squeezed. We're not seeing much relief. We're not seeing much deflation. Actually, deflation is a dirty word to a lot of the people that are running this economy. In fact, we even have reports like this one right here as far as utility bills. What's happening in California? Well, we already have some of the highest utility bills. Now we have the California Public Utilities Commission approving a 13% rate hike for PG&E, and there goes another statistic or another area where inflation is much higher than we're being told. A 13% rate hike. Why don't they factor this into this 3 something percent number that we keep being fed every time the news comes out? Pretty amazing how disconnected these data points are compared to the real cost of living and what people have to pay just to stay alive. In this case, to heat and cool your home and to keep the lights on. The Utilities Commission said the average customer will pay an extra $30 to $35 more per month in their electricity. That may not seem like a lot, but added on top of everything else, and look at the direction that the U.S. consumer is going in right now. And this is not good news at all. And now for the most important news of this report. Hold on to your hats, folks. Don't fall out of your seats. Grab your seats. Take a look at this. Janet Yellen came to California and ate at In-N-Out Burger. This is huge news. I'm so glad that Business Insider took the time to report this. Why are they reporting this? Does anyone care what Janet Yellen ordered at In-N-Out Burger? I wonder if she likes pickles. I don't think she likes pickles. Crazy, right? This is crazy. Why are we talking about what Janet Yellen ordered? It's ridiculous. I think they're trying to do silly news to make up for how bad she's really ran things there over at the Treasury as the Treasury Secretary. And somebody even took footage of Yellen over here ordering for burgers. So see, she's just one of us. She just eats fast food. She just eats burgers. Um, she's not dining at fancy restaurants, right? She's just one of the middle class, right? What else is happening? Well, the U.S. consumer is losing money and their personal savings rate continues to drop. Let's go back to June. It was 4.9%. And let's bring up a chart here for you. June, 4.9%. July, 4.1%. August, 4.0 even. September, 3.4%. We're waiting for the October numbers to come out. I'm going to guess it's going to go lower because we're in the holiday shopping season now. So savings usually goes lower during these months. Then we see a little bit of an uptick sometime in the spring as people recover from the holiday spending and get their tax returns back. But with the high interest rates, this credit card debt could sting, and we may see continual declines in the personal savings rate. Folks, 3.4% as of September. What's going to happen when this hits zero? And at this pace, we drop from 4.9 to 3.4. That's a 1.5% drop. That was just in 4 months. What's another 4 months going to bring? Another 1.5 point drop is going to bring us down to under 2% personal savings rate. And this is how much money people have left over at the end of the month. Oh, I'm sorry. I didn't have the chart up here. Sitting here showing Miss Yellen ordering her food. Here's the chart. June, 4.9%. July, 4.1. August, 4.0. Or just 4%. Why am I saying 4.0? September, 3.4. It could get worse. Yeah, the October numbers are going to be out pretty soon here. October is going to be released on November 30th. So it's about a month lag. We have to wait till the end of November to get the October numbers. But guess what? We're going to be right here on that day to report it for you and place your bets. How much lower is it going to go, or is it going to go up? Are people saving more money, or is it going to dip below 3.4 down into the 2% range? Place your bets. Like to hear from you down in comments. The U.S. savings rate, U.S. consumers close to being maxed out, folks. I think only declining numbers in that particular metric and that particular data point. Next, we have automobile loan debt shooting higher. We go back here to the left side of this chart, and we see we're at about 800 billion or 0.8 trillion, which is 800 billion. Now 1.6 trillion. Basically, the automobile loan debt has doubled. But this is supposed to be a sign of a strong and resilient consumer. Absolutely outrageous that there's people out there falling for this nonsense. Now, let's go ahead and close this video out today with some random news, but still on the topic of finance and savings. In this case, a 100-year-old explains how he still has $1 million saved. Quote, "I always lived within my means. I'm not a gambler," unquote. If I was 100 years old and had $1 million, actually, I would become a gambler. I would probably gamble so much. You can't take it with you, right? So what would you do if you were 100 years old and you had $1 million? I would probably give a lot of it away because I'm not going to be around. What happens if you pass away and then your money gets taken by who knows who's going to take it? Lawyers, right? The estate planning lawyers can come in and take most of the money. I wouldn't want that. So I'd probably give it away. If you're 100 years old, I'd feel comfortable with $10,000 to get by, 100 years old. But maybe not. If you outlive your money and you're on the streets at 100 years old, on the streets at any age, but on the streets at 100 years old, oh, even worse. And I'll really bet this guy can tell us some stories about the cost of living back in the 1920s, the 1930s, living through the Great Depression. Let's see, 100 years old, born in 1923. So Great Depression, what, 1932 or 1930 through 34, whatever they want to call the range of the Great Depression, right around that time. So he would have been about 10 during the Great Depression. So I'm sure he has some memories of it. And for fun, why not go back and take a look? Let's see where gold was back then. Gold was $20.67, folks. So from $20 to just under $2,000 in 100 years. Is that a good investment? I think it's pretty good. And that is the type of gain that I expect to see in silver over the next 5 to 10 years. I know that sounds crazy, but that's what I expect to happen when the system collapses, when this economy collapses, and people realize the reason behind it is all this unbacked currency being implemented and being basically helicopter dropped into the economy. All right, Bulls and Bears, we're going to wrap this up. I may be out for a couple days. You may not see me. You may see me, but there's a chance you might not see me because I have some technical issues I'm dealing with. I actually got a new camera, but my computer will not work with a new camera. I need a better, faster computer. So I've got another computer on the way that's going to work with the new camera. Hopefully the picture will be better and it'll make things look more attractive. Maybe not, but so you may not see me for the next couple days. What's today? As you're watching this, it is Friday. Actually, on second thought, I may put out a couple videos without the screen sharing. We'll see. Anyways, hope everybody is doing well. Keep stacking. I got a couple quick shout outs to go through here for people that help this channel out here. Let me go over to some info on that. And I want to thank the following people. This is a very heartfelt thanks. Why? Because YouTube, the algorithm's not been showing me much love lately. In fact, it's been pretty bad. So you guys are probably the only thing keeping me going right now. Folks, Bulls and Bears, thank you. Thank you to Evergreenification. Interesting screen name there. Thank you for the super thanks and the support. Also, thank you, Christopher Quinn. We go way back, Christopher. Thank you again for another shot of love here. Let's see here. Maria Rivero. We go way back. Thank you, Maria. Longtime supporter of the channel. DJ Jojo. Thank you very, very much. And one more here. Super Chibi. Thank you very much. I love all of you. Thank you for being here. As always, keep stacking. And we'll be back as soon as possible with another dose of economic reality. Hopefully with a nicer camera. We'll see. All right, everybody. Bye now.